If we don't come to an agreement, we could lose our country's AAA credit rating. Not because we didn't have the capacity to pay our bills, we do, but because we didn't have a AAA political system to match our AAA credit rating.
The market seems to have had it with Washington and the latest economic reports. Let's bring in Kevin Craney, trading advisor for RJO Futures from the CME in Chicago. What do you make of this, Kevin? I mean, a very negative week, and the GDP numbers on Friday not good at all, especially the Q1 revision downward significantly, and no deal in Washington.
Yeah, markets certainly very nervous going into the weekend, and the economic data of the day really did not help. You know, the consensus was really all over the board from 0.9% to 2% on GDP, but the mix, if you drill down into the report, just was not good. Higher inflation, lower growth. Really, I think the Fed's got to be scratching their head wondering, you know, what do we do next? And certainly with all the uncertainty in Congress, it just makes things even worse right now.
And I wonder why you think the bond market hasn't reacted yet. You still see 10-year yields around 3%. Why is there this hesitation to react at this point?
You know, I think that's kind of twofold. One, I think the market really believes at the end of the day that the Fed's going to step up or the government's going to step up and pay their bills. I don't think the probability of default is real high. And two, I think you have to also consider the situation in Europe right now. You know, we look at Italian, we look at Spanish bond yields, they're blowing out again. A downgrade of Spanish sovereign debt rating again overnight. That situation is not going away. And you continue to see people go into German bunds. They're coming into the treasuries. Some are coming into the dollar. I'm impressed by how the dollar has really kind of held support here.
Sounds like you're saying the bond market is assuming that Washington's going to get it together, get a deal by the August 2nd deadline. But that does not rule out the chances of a downgrade. And I wonder why you think they're not pricing that in. The equity market is pricing that in, it looks like, but the bond market is not.
Yeah, the equity market definitely pricing that in. I think the probability is certainly getting higher as each day passes and we get closer to that August 2nd deadline that a credit downgrade is coming. I don't think the bond market has reacted yet because in the short term, I don't think it's going to be financial Armageddon if we do get the credit downgrade. Longer term, it's a little bit fuzzy on how the markets are going to react because we are the benchmark for world interest rates. We are our Treasury market is considered the risk-free rate. There is no credit risk. You throw that downgrade in, then it's all really kind of relative because you look at other AAA-rated countries, Britain, France, Germany. Those countries all have their sovereign problems as well, and their bond markets are not as deep and as liquid as ours are. That's what the U.S. enjoys, is those deep liquid bond markets, and I still think at the end of the day, folks are going to come over here and feel safe about putting their money in the long end of the curve.
How are you going into the weekend? Are you just not a holder of anything much heading into this weekend?
I'm not a holder of anything much going into this weekend. I'm comfortable sitting in cash. I am in a little bit of gold. Those are some things I feel comfortable with. If we get a decision, I'd move out of that gold pretty quickly, but still I want to keep my cash position because we don't know how things are going to shake out. We could still get a credit downgrade even if we get some kind of compromise out of Washington, D.C.
Let's say we get a debt deal. Looking broader at this summer, what is the catalyst for a turnaround this summer, or is this what we could call a summer of discontent for equity investors at this point?
Yeah, you know, peeling the onion back by layers, if you will, you know, certainly equities are selling off partly because of all the uncertainty in Washington, but you also have to look at the economic data coming out of Washington. We hit on that earlier about the GDP data that came out here this morning, weak, revised down for the Q1. That's what's at play here. I think the market had priced in an economy that was really starting to pick up in the recovery mode, particularly going into the second half of the year. And now we have to take a step back. Not only do we have to take a step back looking at economic data here in the U.S., but we also have to do that looking globally as well. And so if we get a resolution, which I think we will, the markets pick back up. We trade back over 1,300. I think we could get back up to 1,325, but from there for the rest of the summer, I think really we just stay in a trading range between 1,325 and about 1,295 in the S&Ps.
Got it. Kevin, thank you so much.
Thank you.